Hello everyone. We might try and get started. Must say I'm torn. In my first career I was a fund manager, so I sort of belong here, but my latest career, whether it's my third or fourth, I'm not sure, I belong next door. But anyway, I'm here. And following up that last session, I am an alumnus of ANU, and I must say I'm very pleased with what they did, and I'm glad it helped others move along that path. So my name's John McKinnon. I have a history in funds management. I actually used to work with Eric Smith, one of our other speakers, many, many years ago, back in my first career. Now I'm involved in a number of organisations that are in the divestment movement, impact investing movement. So this is a topic very close to my heart. If you were around this morning, I assume most of you were, you would have got the impression that the hard part of what we're talking about today is what do you do with the money once you've sold the bad stuff? And I think that is the toughest question, particularly for us here in Australia, where we don't have a well-developed clean tech sector you can just go and buy. We don't have a lot of renewable energy companies that are doing well you can just go and buy. It's difficult to know, well, what are the good things we can invest in? And that's what this session's aiming to cover. And we want to present you some ideas of sort of some very positive things, but also from an institutional point of view where you are worried about benchmarks and this sort of thing. Well, what do you do with that money that you've now sold? How do you create portfolios that give you risk and return characteristics that aren't too different from your peers, if that's what you're concerned about? We have two experts to join you this afternoon. Stuart Palmer's Head of Ethics at Australian Ethical Investments, and Eric Smith, the CIO of Redpoint Investment Management. They complement each other well. I've asked Stuart to talk from a sort of a retail investor perspective. So if you're an individual or a small fund with maybe up to $1 million to invest, Stuart will talk about what are the opportunities for you. Eric will come at from a more institutional perspective. So if you're someone investing billions, how do I invest $1 billion portfolio of equities given that I want to divest? So they're the sort of questions we're going to be addressing this afternoon. And I'm going to kick off with sort of filling in the gaps, I suppose is one way of putting it. So what are the options to invest our money positively? Someone before mentioned climate bonds. I think Emma mentioned climate bonds this morning. Essentially bonds that are certified by an external certifier to be green or climate friendly. So essentially externally certified bonds. It's a fairly big market now globally. So in 2015 there were $41 billion worth of these bonds issued. 2016 it's well on the way to going well ahead of that. They're being issued by a whole range of issuers, corporates, multilateral development banks in particular, financial institutions, governments. There's been a couple in Australia. NAB was first in 2014. ANZ came out with the big one last year. Of course, if you want to divest your tier 3 companies, including the banks, these won't be for you. Property is probably one of the easier places to go, and we did hear this morning about the possibility of property upgrades and efficiency upgrades for properties as a key area where some packaging could create some very good investment opportunities. The standard Australian property funds, the big ones you'll know about, Stocklands, GPT, etc., are quite highly rated according to some global ratings agencies on sort of greenness. So I don't know exactly what GRESB stands for, but it's a global property rating service, and those funds there are listed as regional leaders. Now, of course, our region is Southeast Asia, so maybe you want to question how good it is to be a regional leader, but look up GRESB website, you can find out what the ratings are about. As I say, those companies come out pretty high, and all properties, of course, are rated by Neighbours, Green Star, so you can work out which ones are good investments if you want to go green. There are some organisations that are looking at buying the old stuff and upgrading. So one that's already doing that is the Impact Investment Group in Australia, who do two different things. One is buy the best-in-class green companies. Two is buy old properties and upgrade. So you can have a look at those. And hopefully there's more development opportunities of building best-in-class green properties. I think they will come as well. As we've been talking about energy a lot today, it's really an infrastructure asset. I think there are growing opportunities here, but if you're a big institutional player, it's probably still difficult. So there's some people here from Lighthouse. Are they in this room? Yes? Okay, so Lighthouse is one group about to come out with a solar fund. I think looking about 75 million, is that right? Okay, so a decent sized fund investing in long-term PPA assets, so long-term take-off agreements for electricity at multiple scales from sort of household up to utility scale solar. So that's the IM's available imminent. Is that right? Imminent. So, and there's a second one I know about is the E.S.G solar funds, the Impact Investment Group. They'll be in the next few months, is my guess, as to when they'll have a product out, again, targeting $100 million. Small utility scale, I think, is where they'll be, again, long-term PPA. So this is very much infrastructure-type returns, utility-type returns at a commercial level. So these are not concessional-type returns, they're commercial assets. Another one I've thrown up there, just because it's different, and this particular one has a positive environmental outcome, the Murray-Darling Balanced Water Fund, which is investing in water assets, so it's nothing to do with energy, or it's more mitigation of climate change or adaptation of climate change rather than mitigation, I mean. But that, again, aiming to pay something close to a commercial return. There's other water funds that do pay commercial returns. So there are a number of things out there that are in that alternative section of a portfolio that are possible to invest in. And I think we've heard a bit already today from MSCI, but there's a growing number of indexes. I was quite surprised, looked at this and see there are dozens of indexes out there that are coal-free, this free, that free. If you're an index investor, there's all sorts of opportunities for you to buy shares according to an index that will represent your exact ethics. So that's covered off some of the, not really fringe areas, but I think our other two speakers are going to concentrate on equities, which I think is probably the hardest area of the market. So I'm going to introduce Stuart first. So Stuart is Head of Ethics at Australian Ethical Investments, and he'll particularly be focusing on that sort of retail type investor. So over to you, Stuart.
Thank you very much, John. Thank you all for being here. So yeah, I'm from Australian Ethical Investment. We're a superannuation fund, also an investment manager of a range of managed funds. We currently have about $1.4 billion under management. We're an ethical investor, which means all our investments are guided by an ethical charter, which is included in our company constitution, the constitution of all our funds. It's unchanged for the past 30 years that we've been around. 23 principles, which I won't go through broadly, though they direct us to support things, invest to support things which are good for people, animals and the environment, and to avoid unnecessary harms to those things. So climate change is really ever present when we're applying that charter, given the threat that it obviously poses to us all and all of us on this planet. So what I want to do is talk about how we respond to the climate challenge across our portfolios. I will talk a fair bit about what Australian Ethical does, but I'm hoping that will help our more general discussion about how we go about building positive portfolios, both financially and for our climate, given our equities portfolios are basically listed equities, so they're going to be accessible to most investors. So I've mentioned our charter. It basically guides us to certain sectors and to keep away from other sectors. So things like clean energy, healthcare, education are things we're going to invest in, and we're going to avoid companies involved in things like fossil fuels, companies whose businesses involve serious risk of human rights abuse. We're going to stay away from. So, I mean, given that those broad exclusions, hopefully you'll see, yeah, this is not simply a tweak of mainstream portfolios. If you think about it in terms of the ASX 200, we're ruling out about 2/3 by market cap of the ASX 200 right off the bat as being not aligned with our ethical charter. That does not mean that we've got these crazy concentrated portfolios. Indeed, in many ways, they're much more diversified than a mainstream Australian equities portfolio, which has half its capital in 4 banks and 2 miners. So we've across the full range of options from capital stable through to growth, we're able to offer well-diversified portfolios. Just to give you a bit of an idea of some of the companies in our funds, some of them household names, some of them not so household. I mean, transparency is really important to us about both our approach to investing, but also what we invest in. So we do list all the companies we invest in on our website. Some of those names are going to stick out as being part of the response to climate change, the solar, hydro, geothermal, renewable energy companies. Also, we talked a little bit this morning about energy efficiency. That we see that as a really important part of responding to climate change. So recycling, LED lighting, energy efficiency technologies are really important in our portfolios. And of course, there's companies there which aren't going to be part of a direct response to climate change, but they're going to be companies we want to still be around, healthcare companies and so on, which actually have quite a heavy emissions footprint, so we need to find ways, obviously, to help them transition to a zero emissions future as well. So how's that all work from a performance point of view? Here's a graph of our Australian Shares Fund, which is our flagship Australian Equities Fund, previously called the Smaller Companies Fund. So since 1994, when it was established, the blue line is its returns. So that's been about 10% per annum. Down the bottom, the red line is the All Ordinaries, and in between the small industrials index. So that's been a good story. Many of our direct renewables investments are international. We have talked about there probably being a greater range of opportunity internationally at the moment. So we invest in Atlantis Resources, which, whilst I think it has had some trial facilities in Australia, is developing tidal power, renewable energy generation in Scotland, Canada, India and China, I think. Closer to home, investment in renewables has been more challenging for all the sorts of reasons that have been discussed this morning. We have lacked longer-term policy certainty that has been helped by Paris, but we obviously need some of the detail to be worked out, and we talked about some of that detail this morning. From a policy point of view, but just from a technological and infrastructure building point of view, there is an enormous challenge that we face. We do need to reduce emissions right across the economy and society. So this is from 2014, the Climate Change Authority recommended emissions reduction path for Australia, taking into account Australia's capacity to reduce emissions as well as its responsibility, given its history of significant emissions. So we adopted that 18 months ago as a sort of a guide for what we wanted to achieve across all our portfolios. So we set a target deadline of 2050 to achieve zero emissions across all the sectors, across all our portfolios. We do keep that under review as the science changes and it looks like risks are increasing. Also, as our capacity for more quick reduction builds, then we'll keep that deadline under review. As I said, we're looking right across our portfolio. So the energy sector, our energy investments are going to be front and centre when we're thinking about climate, but also agriculture, transport, healthcare and beyond are all sectors where we need to work with companies to see that they're reducing their emissions. And there are two ways that we invest, I guess, two tools which investors have. One is what you choose to invest in and divest from, obviously, and I guess the second tool is what's being talked about next door, which is the advocacy and engagement, and that's a really important role that we think investors should be playing. Industry voices, civil society voices are important voices in the policy debate, but the responsible investing voice is a really powerful one and distinctive one as well. It's not heard enough for a range of reasons. I think many investors tend to sort of sit back and listen and be reactive to what's happening or what they perceive as happening around them. We think that's got to fundamentally change, that investors recognise that they are basically shaping the future by their choices, and they need to do that in a much more considered and a much more vocal way to influence policy. That's just a graph from the International Energy Agency 2015 report, just highlighting the emissions reduction task ahead of us across the different sectors, or some significant different sectors: power, industry, transport and buildings. And they're mapping out of where those reductions are going to come from. So green's the impact of renewables. Energy efficiency is there as the orange component. There's a couple of other components there which probably aren't going to be acceptable to some of us. Carbon capture and storage is up there playing a big role. We certainly have some reservations about the capacity of that to be commercialised as a technology to do the heavy lifting that some were thinking it could do. And nuclear is also up there, and that's not something that we think is part of a response to global warming for any number of reasons, which we could talk about another day. Finally, given we're still close enough to Easter, I thought I'd leave you with that 3D printing image. We invest in Stratasys, which is a leader in 3D printing technology, printers and developing 3D printing technology, which is really going to transform and is transforming the way we design, develop and manufacture products. And I guess the point of that to close is just that clearly renewables, energy efficiency, some of the obvious technologies and infrastructure requirements are going to be at the centre of the response to climate change. But there's a whole range of technologies out there which we need to keep investing in, which probably in ways we can't quite envisage will be a really important part of an effective response to global warming.
When I started in funds management back in 1995, we had to find a default super fund for our firm, and I think we chose Fin Super because that was our industry fund, financial super. And due to a range of mergers and ever since, they're now Australian Super, and I think they've got somewhere around about $100 billion or something now. Someone here might know the answer, but they're big, right? They're big. And I want to see them divest. And the accepted wisdom is that a fund that big can't divest because they just can't build an Australian equities portfolio as big as they need to without some of the big guys that they're going to have to divest from. And that's, I think, the answer we need to, it's a question we need to answer if we're to take this movement forward into that size of fund and into the mainstream. And that's why we have Eric Smith here to speak to us today. Eric is CIO of Redpoint Investment Management. Eric has been one of Australia's foremost quantitative fund managers for at least the last 20 years, since I think we worked together back in 1994. He then went and became the CIO of Vanguard, which was a global index manager, probably one of the biggest fund managers in the world at the time. So we have one of our foremost experts here to tell us how can that be done? How can the big guys do this?
Thanks, John. The universal owner, as we sort of, the term bandied around when we're reflecting on the Australian supers of the world, and I think they were 99 point something last time I looked, John, there, billion. So almost universally, the large super funds and a lot of smaller funds and endowments and others investing in a sort of a well-diversified across asset class portfolio use indexes to reflect the public market dimensions of their investments. And of course, these indexes, provided by vendors like MSCI and S&P, do a pretty good job of reflecting, the markets they're looking to reflect. But they essentially embody a series of characteristics that allow investors to make assessments of what they believe the looking forward relationships will be in terms of correlations and volatility and risks, etc. And they also provide often an opportunity set that managers are often held to invest within. We heard earlier today, for those in the session with Bruce earlier, there's about 10,000 securities in a portfolio like local government. And yet, we can map those portfolios down to somewhere between about 50 and 200 characteristics, if you like, that can be used to reflect or summarise that aggregate portfolio. And the number varies depending on whose risk modelling you prefer, but it picks up obvious things like currency and the country of origin or the country of domicile of companies and the bond issuers, and then also financial characteristics like whether they're value-oriented or growth-oriented types of investments. But in a sense, we have these factor exposures. And when we're looking at the concept of divestment and really saying, look, what we want to do is get rid of an exposure, at least say we want to eliminate carbon, fossil fuel reserves, as an example. We're really trying to eliminate a single factor in a portfolio, and ideally, in an ideal world, we'd leave all of the other factors untouched, because those factors embody all of the things we're looking to capture characteristically through time. They're sort of the economic transition or transfer of economic activity through to investment returns in the hands of the asset owners. And so what we find in actuality, of course, is that we get the intended outcome of a low carbon portfolio when we divest from the various assets, but we also get sort of consequential biases built in, because as soon as we start shifting from the tier one assets, the pure plays and things like coal companies or gas producers, to the tier two and tier three, where we actually have sort of multiple diversified activities within a single organisation, we are clearly going to be affecting these other factors. And these are the things that drive a variation in outcome that the institutional investor in particular is looking to try and moderate. That really what we're going to do is deal with that, the redeployment of these consequential bets arise typically because if you just eliminate something and then just let the money float to everything else you own, you're simply scaling up the biggest of the things you already own. And so in the Australian context, if you eliminate BHP, 40% of the dollars you previously had invested in BHP will automatically end up on the banks if you don't make a conscious decision about the redeployment of those dollars. And of course, you now not only have a lower carbon bet, you have a bet against other resource factors, and you have a bet in favour of the banks. And it's really the way you go about redeploying or reinvesting the divested dollars that allow you to sort of bring the aggregate portfolio characteristics back as close as possible to the portfolio characteristics you are trying to capture through time. What we found when we're looking at these, is my first experience in a low carbon portfolio was one that was focused on a reduced carbon footprint, the carbon intensity type of measure that we heard about from Sydney University's experience earlier today. Now, that was back in 2008, working at Vanguard to try and develop a portfolio for a superannuation fund client who'd been an investor in the sustainability space since about 2000, but they wanted to introduce an explicit position taken with respect to carbon footprinting. What we've seen in the period since then, and particularly since the early 2014, we've seen a multitude of offerings from the major index vendors, MSCI, S&P, stocks, FTSE, all have low carbon offerings, and they all have multiple offerings, so different flavours for different types of investors. So we have some fairly simple or single purpose funds divesting from carbon fossil fuel reserves, and we have others that may be simply looking to lower the carbon footprint across all sectors. So they're looking to invest in the more efficient companies, those that use less carbon intensity in generating a given output in a particular space. So whether it's comparing Apple to Samsung or in those types of spaces, they're looking for which of those companies is more efficient in the utilisation and hence has a lower intensity of carbon generation in its supply chain effectively. And importantly, some of them hybridise these things. So they use a mix of either screening and then biasing away from the high emitters to lower emitters, or in fact they quantify and standardise the fossil fuel reserves dimension and turn it into an equivalent emissions. So the future potential emissions being added to the existing emissions activity of various companies, and look to build a portfolio that minimises those exposures while maintaining everything else as neutral. But in a global sense, it's a relatively simple exercise. There's a lot of degrees of freedom in a global portfolio. No one company is too big to eliminate and deal with the consequences in terms of its impact. And even the very simple approaches which simply allow that divested money to float over the assets that remain in the portfolio on a cap-weighted basis, delivers a reasonably risk-controlled portfolio. At the other end of the spectrum, you have those that try and optimise the result. It's something that as a quant manager we're very familiar with. Some of you, we all optimise decisions in life. We're looking to make decisions that give us the lowest cost path to an outcome. When we're looking to optimise a portfolio structure, we're looking to really preserve the factor we're biasing towards or biasing away from, and try and as much as possible eliminate the other common factors by rejigging the weightings and reallocating or reinvesting that released capital in a means that in effect fills the gaps and moderates the overloading of particular dimensions. But the problem we face as Australian equity investors or Australian domiciled investors investing in equities both domestically and globally is the fact that we have a massive home country bias. Australia is around about 2.8% of the global equity space. If you look at a benchmark like MSCI's All Country benchmark, which has got developed and emerging markets, and yet we find that a typical allocation in the equity component, the listed equity component of a large fund's portfolio will be roughly 50-50 allocated to Australian equities and international equities. And just taking the numbers from the Carbon Underground 200, the report from last year is the one I had to hand. What this report looks at is the 200, the 100 largest owners of coal reserves and the largest 100 owners of oil and gas reserves, and looks at them in terms of potential emissions if all that reserve was burnt. So we're talking gigatons of carbon dioxide output. And in those 200 companies that they've selected or identified as being the largest holders of reserves, we have 556 gigatons of potential emissions, which is obviously way more than can be emitted if we're to deliver on the climate goals that have been established. But within that, you can see, although Australia, in a market capitalisation sense of its companies, is only 2.8% of the world, the fossil fuel reserves and the potential emissions from that is a much higher proportion. 33.5, leaving 52.25 for the rest of the world. So we're talking around 6 or 7%, roughly double the amount you'd naturally expect. And if you bring that to a 50-50 allocation, you end up with a circumstance where roughly twice your fossil fuel exposure, reserves exposure, resides in the Australian component of your portfolio, as it does in the international component. So in the international sense, we can eliminate all of those companies and introduce relatively little risk into the equation. The total volatility, the total risk of your portfolio can be identical. There will be some tracking error, but it's relatively mild, as we heard from, again, the experience of local government super this morning. But when it comes to the Australian context, where we've got this massive footprint, a large part of that footprint resides in the Tier 3 assets in the list we saw earlier. Now, they've been tagged as being engage or divest. When we're talking about divesting, we're talking about divesting from BHP, Rio and Wesfarmers. So we can get rid of the Whitehavens and the rest of it. That's almost a trivial risk impact in the overall equation. But when we look to divest from BHP and Rio, we have to say, well, how are we going to deal with that? And I think for, if you like, a medium-sized fund, not to the size of an Australian super, you can still contemplate staying local. You can divest from BHP and Rio. It's going to, and Wesfarmers between them, I think the number is, roughly in the order of 10 or 12% of your total portfolio. And you can look to reallocate that capital into spaces that are going to have similar economic responses to the things you've just eliminated, because the issue you're dealing with when you deal with BHP and Rio, of course, is that they're primary drivers of their returns and their balance sheets in a dollar value sense in those companies is iron ore, not the coal assets and not the gas assets or the oil assets. And so, and in Wesfarmers' case, it's the retail businesses that they own, etc. So each of those things, though, gives you an opportunity to look for an alternative. And if you just took the money out and let it float to the rest of the portfolio. It's effectively an allocation switch to the industrial space, and within that the financials, being the banks. But if you consciously choose, you can actually reallocate that capital across everything else that's left within the resource space. And if you're a larger company, you can look, a larger fund I should say, you should really be looking at this as an asset allocation decision, because when we look at the Australian market, we sort of make this natural allocate. We tend to make a decision saying how much in international and how much in the Australian market, but we don't look at what the division in the Australian market is or should be. And we just allow the natural weighting, if you like, between resources and industrials to play out. But the reality is that there's a bigger gap between those two parts of the market treated as independent portfolios than there is in the relationship between the industrials piece and, say, the S&P 500 reflecting the US market. So, my proposal or suggestion to people looking to divest from the BHP and Rio components in particular would be to treat this as an overall asset allocation decision and make a conscious bet about how to reinvest into the resource space, because what we've seen through time is that when energy is done well, so have other resources. And so we don't have to be investing into other coal companies in order to replace the ones we've just divested from. We can invest into other commodity-sensitive parts of the spectrum and capture the overall characteristics. Just to give some sense of why you want to preserve an allocation to the resource space, is this goes back to March 2000, so it's a 15-year window of performance. It was after the tech wreck, and it was the last time resource stocks had a relatively low weighting in the Australian market. And we saw a run-up of a 400% return to the period there in 2008, and again peaking again in 2011, at the time when the industrials dimension, which is the bottom red line there, had just over 100% return. We saw the decline in both sectors in 2008 into 2009, but a much more rapid and strong recovery for the resource component. So if you just allow that divested component, which is substantially coming out of the resource sector, to float off into the industrial space, you run that risk, and this comes back to that issue of whether it's trend or cyclical. Even if it's cyclical, it can hurt you for quite a long time in the short run. But you don't have to be reinvesting into energy assets in order to capture a lot of the characteristics that really relate to that resource space. And just to give a quick snapshot on that, the white line's the same one as the previous one. It's the resource index picking everything up. The red line is, or orange line is BHP, and the yellow line is Rio. And you can see that there are some quite big swings and roundabouts, but you've in fact got in that particular time you would have had a sort of almost a barbell bet by taking out both BHP and Rio. And the balance of the resources index would have performed at gross level in line with the sector, including BHP and Rio. So it is practical to consider a BHP Rio exclusion as an institutional investor. I would suggest, though, that when it comes to larger scale, rather than trying to make all that substitution of alternative resource assets in the Australian market, it be considered an explicit allocation decision and be made on a more global perspective, because resource stocks are fundamentally global, not local anyway. And just in terms of the options, I think for the global vendor indexes do a pretty good job. You can improve on it by tailoring the result and choosing how to optimise, and you can embed other decisions such as broader E.S.G considerations and screening in the same portfolio with very little extra risk impact. Worth considering. In Australia, a tailored solution to dealing with the problem is really the only practical solution, but it is a practical solution and doable, whether kept locally or looking to be expanded globally and treated more as an asset allocation call. Thanks.
Thank you, Eric. Got time for a couple of questions. Rather than get you to come up here, probably if you just stay there. Do we have a couple of questions for Eric or Stuart? Yes.
Hi, Jackie Courtney. I had one for Stuart. When they showed us the breakdown of I think it was the International Energy Agency, was it with the power industry, transport, buildings? There was no agriculture. Why was that?
No, well, I just think that's the focus of the IEA.
Right,
really.
okay.
But yes, obviously a key sector as well. Yeah.
Right, okay,
Yep.
just in regards to emissions, no one's
Yep.
mentioned it. Yeah.
Yep.
Is there a microphone at the back?
Max Horster. I have a question for both of you. When you talk about the investment strategies, you typically exclude, Stuart, you certainly do exclude entire sectors. When you look at what's going on out there, you see that there are investors excluding based on thresholds, right? Excluding based on a certain percentage of revenue from coal or so. What do you make out of that? What's your answer to them?
Well, yeah, we think it is essential to track that, because although any given company will get classified in a particular industry sector, typically, yeah, it'll be involved in a range of things. So I think underneath our charter, we've got frameworks for different industries, and I think there are roughly 200 thresholds that we have applying to different products and services within those industries. So we need to be able to deal with a company like Contact Energy, for example, which certainly over 2/3 of its revenue is from renewable energy. It does derive some revenue from natural gas, but sufficiently small that it still allows us to invest in that company. Does that answer? Yeah.
Yeah, I think when you're looking at from a divestment point of view, tolerances may help, but the problem is that something like BHP, roughly 7% of its revenues, 15% of its revenues come from its fossil fuel division. In Rio's case, it's about 7%. Yet between the two of them, they own over half of the reserves in the Australian market in terms of your portfolio exposure. And so if you want to eliminate that exposure because it's a real downside risk, you have a large investment in those companies. And you have to make a large divestment in order to take away that quite large dollar value sitting on someone's balance sheet that we think in the future may be worthless. Without going into lots of detail there, but it is practical to compensate for the other elements that you just got rid of at the same time, such as you iron ore exposure, etc., or a broader commodities type thing. In other cases, such as the carbon intensity, you can let the optimisation process deal with that, and what it tends to do is de-weight the most those with the highest intensity for a given activity. But it can balance the reduction versus the risk that is inherent in coming from that.
I think that's time, afternoon tea time. Thank you, everyone. Please thank Eric and Stuart.